Hello, and welcome to the latest edition of the Quarterly View from Glassy Mountain Advisors. I'm Jordan Smythe, the founder of Glassy Mountain Advisors, and it's good to have you back with us for this presentation. I'm going to begin by providing an overview of the stock market's performance in the second quarter of 2023, and then provide our outlook and some investment implications. The U.S. stock market continued to climb in the second quarter of 2023, prevailing in the face of challenges including persistent inflation, fears of recession, and the war in Ukraine. Despite higher interest rates resulting from the U.S. Federal Reserve's efforts to reduce inflation, the economy has remained strong and consumer confidence is still high. As we enter the second quarter earnings season, analysts expect corporate earnings to decline, but they still forecast a slight increase in earnings for 2023. Valuation measures such as the price-earnings ratio, or PE, are higher than they were at the end of the last quarter, and we think stocks will remain around current levels in the coming months as investors consider earnings and economic reports. The S&P 500 index rose 8.7%, including dividends, in the second quarter and was up 16.9% for the first half of the year. Technology stocks led the way again, with the best performances concentrated in several of the largest tech companies. The NASDAQ Composite Index has risen 32% in 2023, after lagging the broad market last year. U.S. stocks continued to perform better than most foreign stocks, and small capitalization stocks recently surged on signs of economic strength. Stock market volatility declined to pre-pandemic levels, though there was a wide dispersion of returns between the best and the worst performers. The yield on the 10-year Treasury rose and is currently 3.8% compared to 3% a year ago. Entering this year, the Fed's commitment to reduce inflation by raising interest rates had many worried that the U.S. economy could fall into a recession. By most measures, however, the economy remains strong and recession fears are easing. First quarter GDP increased 2%, and the June jobs report showed that hiring is slowing yet still robust. Even though the 209,000 jobs added was the smallest gain since December of 2020, the increase reflects the 30th consecutive month of jobs increases and is unlikely to prevent the Fed from raising rates again at its next meeting, particularly since wage gains were again strong. The unemployment rate ticked down slightly to 3.6% in June, matching the average over the past 12 months. Consumer confidence soared in June to its highest level since January 2022, an indication that consumer spending will likely remain strong despite cooling a bit in May. Durable goods orders have increased for 3 straight months, a sign of health in the manufacturing sector, though the manufacturing PMI, another key reading of manufacturing sector health, showed weakness. The real estate sector is also mixed. Home prices are ticking back up largely due to constrained inventory, as homeowners with low-rate mortgages have been reluctant to sell. In contrast, commercial real estate is troubled, particularly in downtown areas hard hit by the trend towards remote work. Fortunately, the political battle over the debt ceiling resolved before severely damaging the economy, though political dysfunction still hangs over the markets as an ongoing risk. The Consumer Price Index in the United States, which was most recently 3% for the past year, has fallen steadily to less than a third the rate of a year ago. Core inflation, which excludes food and energy, has also declined but remains a bit higher at 4.8% over the past year. After seeing some improvement and hoping to get a better gauge of the full effects of past interest rate increases, the Fed held rates steady at its most recent meeting in June. We think the Fed will still increase the federal funds rate by 0.25% at its next meeting later this month, but that rate hike could be the last of this campaign. Foreign economies showed some weakness. War continued in Ukraine and contributed to inflation in Europe, which is running higher than in the United States. The European Central Bank continued to raise interest rates to fight inflation and seems unlikely to pause soon. After starting to rebound from the pandemic, China's economic growth slowed recently due to weakening consumer confidence and slumping real estate investment. Following a very strong start in the first half of the year, stocks may hover around current levels as the economic picture and earnings outlooks become clearer. The performance of the largest tech companies, whose stocks have accounted for much of the gains so far this year and are heavily weighted in the S&P 500 index, will be critical to the broader market's performance. As companies report earnings for the second quarter, investors will be closely watching for signs of weakening consumer spending after broad price increases by businesses trying to boost profit margins. Current expectations are for a 7.2% decline in S&P 500 index companies' earnings, which would mark the third consecutive quarterly drop. However, analysts expect earnings growth to pick up in the second half of the year, leading to a slight increase for the full year. We are optimistic the Fed may succeed in its efforts to quell inflation without sending the economy into recession, but challenges still linger. Given its target inflation rate of 2%, the Fed is likely to raise rates further, but we believe the Fed is nearing the end of the rate hiking cycle and are optimistic that the U.S. economy will avoid a recession. The European Central Bank will most likely continue boosting interest rates. Combined with the ongoing war in Ukraine, these actions will probably dampen economic growth in the Eurozone. We continue to favor bonds in our income allocations, though we still like certain equities with higher yields. With short-term interest rates around 5%, we are happy to own more short-term bonds and are trying to limit our exposure to interest rate risk. Even cash in money market funds is yielding 4.5% or 5%, a level that we have not seen in many years. The S&P 500 index is currently trading for about 19 times estimated earnings for the next year, slightly above the index's 5-year average of 18.6 times. We expect investors to be more cautious as they wait to see earnings results, and we remain optimistic that patient investors will still enjoy attractive returns over the long term, even after the recent rise. Thank you for taking the time to join us. We hope you enjoyed this presentation. We welcome your questions, comments, or suggestions, as always, and we look forward to talking with you or seeing you sometime soon. Enjoy your summer. Take care.